Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. The walk back relief rally, stocks and bonds rise as President Trump tries to diffuse tensions over Chair Powell and China tariffs. Shifting focus, Elon Musk says that he'll pull back from DOGE to concentrate on Tesla. Shares rise despite a miss on earnings. And Intel announces plans for a significant job cut this week. More on that Bloomberg scoop coming up. It is another pivot rally this morning. We are up more than 2% across the board for these future indices. The Nasdaq 100 up nearly 2.5%. We are now down only about 5.5% for Liberation Day. We're flat from Trump's Powell termination Truth Social tweet. The Treasury Secretary yesterday at a private event suggesting that the standoff with China is unsustainable. Expect de-escalation. Trump later echoes that, and Trump says no intention of firing Powell. So this is the picture you get. Stocks rally. Dollar rally, although I should say that rally is starting to peter out on the dollar, but spreads tighten and duration rallies too. Let's take a look at your bond market because that continues. Your 30-year yield down by 8 basis points. It is the long end leading the rally yesterday. 2-year yields were a bit softer. We're unchanged this morning. Your 10-year lower by 6 basis points at 434. We will get an auction of 5 years today. And gold, you can see, takes a breather from the record high after posting 22 record highs so far this year. Gold weaker this morning by 1.75%. Let's take a look at some of the stocks moving this morning in the pre-market. Here with that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So Tesla, the real focus today. Take a look where we're trading at the moment. We're up around 6% now. The earnings looking a little bit light, but most of the focus on Trump or Musk. Getting my two mixed up there. Musk saying he's going to potentially step back from his role with DOGE. So that is the positivity. Trump in the headlines so much I can't stop thinking about him today. But then we've also got Intel announcing potentially 20% job cuts across the business. The new CEO there is wasting no time in ringing the changes after coming in just a month ago. Intel gaining 3% on the potential boost to the efficiency in that one. And then one stock sliding is Halliburton, saying that a lot has changed over the past few weeks in terms of the tariff outlook. That stock was a little bit lower. I'm having a shocker today. That was lower before I headed over. It's actually higher now. They have downgraded some of their forecasts. Keep an eye on that one as the trading day progresses.
Yeah, Joe, I mean, things can change in an instant in today's markets. I think we've come to realize that. Joe, thank you so much. Bloomberg's Joe Easton there with your stocks to watch. And in just a few moments, we're going to be catching up with Allen of Deutsche Bank later in the hour, Thierry Wizman of Macquarie, and Stephanie Brinley of S&P Global Mobility on those Tesla earnings, which Joe was just talking about. But back to the market, stocks gaining from back-to-back losses at the start of the week after President Trump softened his tone both on Fed Chair Powell and tariffs on China. Allen of Deutsche Bank weighing in on the administration's market rhetoric, writing, quote, "There is still some sort of Trump put in place, and the administration are sensitive to financial turmoil." Indeed, Trump himself commented that the bond market is very tricky, and it's not in the administration's interest for there to be a recession. I'm pleased to say that Henry joins us now, macro strategist at Deutsche Bank. And Henry, I want to be clear, you originally wrote that about the 90-day pause in tariffs, but it could aptly apply to what we heard yesterday from the president. Is this still a market in charge of policy?
Hi, Danny. And yes, I think it is to some extent, because it's clear that over recent days we've kind of found and we're starting to find where that Trump put is. Of course, we first had that 90-day extension in response to all that bond market turmoil. And then over the last 24 hours, directly following the sell-off on Monday, we've had Trump say that he has no intention of firing Fed Chair Jay Powell and has talked about dialing back tariffs on China as well. So I think it's clear that this is an administration that's pretty sensitive to financial turmoil. And even if there might be a higher threshold for that than there was in Trump's first term, they don't have an infinite tolerance for that.
Well, look, there's clearly near-term bullish implications. You can see that even in what equity markets did late yesterday and so far this morning. But Henry, what about the medium to long term? Because we're still in a volatile headline environment. Did these type of walkbacks, do they stem the sort of sell America, rotate from the U.S. to rest of world trade?
I think they do to some extent, because firstly, even if this chronic uncertainty persists, I think after about 6 to 9 months, we will just start to get used to it as a fact of life. And I think although some of the American exceptionalism trade was perhaps over-egged at the end of last year, it's worth bearing in mind there's still, a lot of bullish fundamentals if we look to that kind of medium to longer term 5 to 10 year view behind America. I mean, something I was really struck by yesterday was that as the IMF downgraded their growth forecast, and indeed the US in particular, the US for 2025 and 2026 still had the fastest growing projection in the entire G7. They have growth rates that Europe would still love to have. So I think that if you look at the fundamentals behind the US economy, a lot of those features are still pretty strong.
Well, you've been also writing about, Henry, this divergence in the hard versus the soft data. You could argue we've even seen it in some of these company earnings reports, the fact that the current quarter and the quarter that they're reporting looks strong. But looking ahead, they say, I don't know. Here are the various scenarios that we're laying out. Here's the big range of hit that our earnings could take depending on what tariffs do. How long does it take for that sort of thing to filter into the economy? Do you assume that it does come to fruition at some point, that the hard data at some point catches up to the negative sentiment?
I don't think that's necessarily a given, because I think in response to surveys, it's very easy to say, I think things are terrible, things feel really bad right now, particularly when, as we've had in recent weeks, a lot of negative headlines. I think that hard data is going to be the real test, because actually I remember in 2022, when the Fed were launching into the most aggressive rate hikes in a generation to bring down inflation, the soft data, the surveys, looked a lot worse than the hard data ever got. We didn't have a recession that was predicted by many in the end. So, as I think we look forward to the months ahead, clearly, I think the hard data is likely to turn down. But actually, whether we get the extent of the downturn we see in the surveys right now is still an open question. And I think that's not going to become evident until more May, June time, because already we have seen, even so far this month, some front running in response to the tariffs. And actually, the limited hard data we do have, for instance, the weekly initial jobless claims since Liberation Day, those have actually remained pretty strong so far.
Yeah, I was going to say, I noted down a couple earnings comments. Henry, Capital One saying that consumers are still solidly in the game. Kimberly Clark saying that they are making no changes when it comes to spending on things like innovation and marketing. Verizon, no major consumer shifts in behavior. Amex, overall spending levels have remained consistent. Is there a degree, though, you mentioned the pull forward because of tariffs, that could be what we're seeing from the consumer in its strength, that they are getting ahead of some of the perceived price increases that could be coming from tariffs?
I think that's definitely going to be a feature, yes. And actually, we're going to have to be pretty careful when we're digesting some of the Q1, some of the April data, and actually even to some extent over May and June, because if consumers believe that after 90 days we've got this extension period, if those tariffs do come into effect after those 90 days, then you could see that pull forward effect perhaps carry on into Q2 to some extent. So the real test is going to be, can Trump signal or perhaps even achieve some of those trade deals he's talked about with other nations? Do markets and consumers start to see signs that those tariffs are being dialed back in a durable way, signs that perhaps we're at peak tariff, so to speak? And if we do, then I think there's every possibility that the consumer, yes, there's going to be a hit to some extent, but I think the consumer can ride through that without a recession. I remember, again, back in 2022, the S&P 500 saw a peak to trough decline of 25%. And right now we're down peak to trough about 14%, given where futures are. That would take us up to about 12%. So right now we're only seeing about half of that 2022 decline, which wasn't capable of taking us down to recession, at least as a result of those wealth effects. So I think, the market so far isn't pricing that recession in fully. We're not seeing, across a range of asset classes, across equity declines, across credit spreads in oil prices, we're not seeing those recession-like declines that you would expect if people did think we were going to have a recession.
Well, Henry, I have to say, you sound quite bullish, all things considered, in this environment. But I have to wonder, paradigm shifts, they take not just a couple of days to happen, but months, if not years. Is there a scenario where we don't get a recession? There's no crash, there's no financial crisis, but the U.S. just kind of muddles along, and the actions that we've seen from this administration slowly erode things. Is that a scenario you hold on to, or can we really get back to normal and that this isn't a time of paradigm shift?
I think, the big test will be over the kind of coming weeks and months, because, I know we've heard a lot about the potential for the US dollar to lose its reserve currency status, but given how many legal contracts that's wired into, that process, as we saw for the pound sterling a century ago, can take a very, very, very long time. And one thing I'm conscious of, amidst all the political events in the United States. I remember in the early 2010s, around the debt ceiling crisis of 2011, and then you had the fiscal cliff in 2013, there was this narrative that the US was losing its edge, that growth was slower after 2008, that political gridlock was going to get in the way of continued market exceptionalism. But actually, the S&P did very, very well in that environment, at least on a longer term time frame, looking out over a 5 or 10-year horizon. So political gridlock by itself is not enough, we've seen historically, to take markets down. If anything, actually, markets are pretty resilient against geopolitics. I think the big question will be, do the tariffs have a macroeconomic impact? And actually there, the administration have shown that when it has started to have an impact on the markets, and we may see it have an impact on consumer prices shortly, they are willing to dial that back. So I think there are quite a few natural corrective mechanisms that would mean even if we do see a downturn, the administration's incentives and their policy tools will prevent that from being a particularly sharp one.
Henry, it is such a pleasure to have you on. Unfortunately, that's all we have time for. We could do this all day. Henry Allen of Deutsche Bank, please come and join us again soon. Let's get you some other top stories now that are trending on the terminal this morning. Janus Henderson weighing a 10% cut to its exposure to U.S. assets following the trade turmoil. The firm's CEO told Bloomberg that he could see a tenth of client exposure reallocation from the U.S. to Europe, China, the Middle East, or Latin America. The admission underscores a growing shift away from the world's largest financial market. Cantor Fitzgerald, Tether, and SoftBank are in talks to form a $3 billion crypto firm. Bloomberg sources reveal that the deal is expected to be announced in the coming days. Cantor formed a SPAC in January, raising $200 million to create a new firm. Tether will contribute $1.5 billion in Bitcoin, while SoftBank plans to put in $900 million. Vice President J.D. Vance says it's time for Russia and Ukraine to say yes to the U.S.'s latest proposal for peace, or else the U.S. will walk away from the process. Speaking to reporters in India, Vance said territory concessions from both sides would be needed for a deal between Kyiv and Moscow, with new lines being drawn close to where the current front line is in the war. Coming up, playing nice with China. President Trump possibly softening his stance on the country. If they make a trade deal, tariffs will be somewhere between 0 and 145%. We're going to discuss and give you the details next.
I'm not going to say, oh, I'm going to play hardball with China. I'm going to play hardball with you, President Xi. No. We're going to be very nice. They're going to be very nice, and we'll see what happens. But ultimately, they have to make a deal, because otherwise they're not going to be able to deal in the United States. So we want them involved.
Can you call it a walk back? President Trump potentially softening his stance and cutting China's tariffs, what he says will substantially be from 145%. Where that will be, we're not certain, but if they are able to make a trade deal. The POTUS is saying that levies will, quote, come down substantially, but it won't be 0. So the range we now have is somewhere above 0, but below 145%. Joining us now for more is Bloomberg trade czar Brendan Murray. And Brendan, the conversation we've had here is just from the Trump team side. Do we know anything as to whether China's actually involved in conversations, or are we witnessing a U.S. that's negotiating with itself?
Yeah, exactly. So these are some of the most conciliatory comments that we've heard from Washington. We heard from Trump. We also heard from Treasury Secretary Scott Bessent. And remember, up until now, we've had nothing but escalating rhetoric, escalating tariffs. So what we're seeing, it seems to be, is the Trump administration saying, look, our hardball tactics aren't working. We're not getting anywhere with China and trying to get negotiations underway. So maybe let's tone things down a bit and see if that helps. The flip side of that is it's going to take a lot more than happy talk to get the Chinese to come to the negotiating table. They are facing 145% tariffs on all their exports to the U.S., or most of their exports to the U.S. So there's a lot of economic dislocation going on in China right now, and they're going to want to see, Beijing is going to want to see some pledges that those tariffs are going to come down, and not just talk of them happening. They want to see some action.
raises the question who actually has the upper hand if the U.S. is being dictated by markets. Brendan, you mentioned the Treasury Secretary's comments. I mean, we should point out they weren't public comments. They were behind closed doors to J.P. Morgan bankers. But at the same time, his unsustainable comments was something he said very similar to Anne-Marie Hordern just last week. But doesn't make clear the fact that we had Scott Bessent talk to Anne-Marie about that, the fact that he said these comments not too long before we heard from the president himself. Doesn't make clear that Scott Bessent does have the president's ear, that he is maybe not in charge, but is a bigger influence when it comes to trade conversations than others in the cabinet?
Yeah, until now, it's basically been whoever's standing in front of the camera dictates the tone of the Trump administration stance toward China. So the tariffs that the U.S. has imposed on China will lead to a decoupling over the longer term. Economists are unanimous about that. What we heard from the Treasury Secretary was that is not the goal. So if the goal is to bring the two sides to the negotiating table, the hardball tactics, as the president referred to them, aren't getting them anywhere. So I think what we're seeing is the more dovish side of the Trump administration's trade team trying to get out in front of this. They're seeing markets fall. They're seeing forecasts for their global economy go down. So the pressure, the leverage is can work both ways, and China really has time on its side. So I think that the Trump administration is trying to put something together, put something on the fast track here, rather than just kind of have this standstill. This talks basically go nowhere.
Right. I mean, look, if this is capitulation, and we're certainly not saying it is, what does it say for the rest of talks that the administration has to undergo with various countries? Brendan, much more to discuss with you. Thank you so much for joining this morning, Bloomberg's Brendan Murray. Coming up, Intel is said to be cutting 20% of its staff. A Bloomberg scoop. We're going to bring you the details of what's going on at the tech player. That's coming up next on your Bloomberg Brief. Let's take a look at what the front pages are running with this morning. First up, on the Washington Post, they're leading with Trump's inner circle weighing whether the White House should push for higher taxes on millionaires. The Post reporting that the vice president and budget director, Russell Vought, have expressed an openness to the idea, despite a chilly reception, as you'd imagine, among Republicans on the Hill. Next up, the Journal has this, reporting that America's elite universities are raising cash. Princeton, Northwestern, and Harvard have all issued hundreds of millions of dollars worth of bonds. Yale, meanwhile, is trying to sell billions in its private equity holdings. That off the back of a funding freeze from the Trump administration on some colleges. Finally, the FT reporting that Russian President Vladimir Putin has offered to halt his invasion of Ukraine along the current front line. 3 FT sources say that Putin has told that U.S. Special Envoy Steve Witkoff that Moscow could let go of its claim to areas of 4 partially occupied Ukrainian regions. Now, one of our other top stories this morning, let's get a check on Intel shares because they are moving higher by 3.4% in the pre-market. The chip maker set to announce a larger than 20% cut to its staff. That, according to Bloomberg sources. Let's now bring in Bloomberg's Charlie Wells, who joins us for more. Charlie, what do we know?
Yeah, Danny, so we know that this is a significant cut, and this is the first major reorganization under the tenure of Lip-Bu Tan, the new CEO of Intel, who was named just last month. And this is going to be something of an indication of how Tan may try to turn Intel around. That's been what he's been tasked with at this struggling chip maker, which has certainly lost ground to the likes of NVIDIA, as they've taken a lot of ground in the artificial intelligence front. And Intel has also lost a lot in the personal computing space as well. So this could be a sign that Tan doesn't have a lot of options and needs to cut. Staff at the end of 2024 stood at about 109,000 employees, and this follows cuts that were attempted in 2024 of about 15,000 people.
Beyond just staff cuts, Charlie, do we understand that other changes that Lip-Bu Tan is trying to make at Intel?
What we know is that he's trying to streamline the business and return to a lot of those core values. And so the person familiar with the matter told Bloomberg that this was in line with trying to get back to that engineering culture. Tan has also indicated that he is willing to strip away parts of the business that are just not mission critical. So we heard about a sale to Silver Lake of one of these business units last week of 51%, and trying to kind of strip away some of these units that just are not kind of core to the functionality. And that seems to be a kind of two-pronged approach, cutting staff, but also business units that just aren't performing in the same way, that are not central to the way that Tan is going to need to reorient the business. Now, he's going to probably give an indication of a little bit more of his strategy on earnings tomorrow, and those will hopefully give a little bit more clarity on what's happening in the business.
Yeah, that's going to be a must-watch and must-listen to Intel reporting after the market close tomorrow. Charlie, thank you so much. Bloomberg's Charlie Wells. A quick check on markets as we head into the break. It's not just Intel rallying, it is stocks in general after Trump walking back his comments on Powell and saying that they're going to play nice with China. But is the U.S. negotiating with itself? You can see there across the board, equity is higher, but interesting development in the dollar. The dollar initially strengthening off the back of that result. That gain starting to peter out this morning. And we're going to discuss just that coming up. Another Trump pivot sparks a market pivot. More on the dollar relief. And if it can come back, we're going to catch up with Macquarie's Thierry Wizman. That's coming up next on your Bloomberg Brief. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. The walk-back relief rally, stocks and bonds rise as President Trump tries to diffuse tensions over Chair Powell and China tariffs. Shifting focus, Elon Musk says that he'll pull back from DOGE to concentrate on Tesla. Shares rise despite a big earnings miss. And Intel plans to announce a significant job cut this week. We're going to have more on that Bloomberg scoop throughout the show. And it is a rally, at least in this equity market. It's pretty sizable, up more than 2% in the pre-market trade, up nearly 2.5% for your NASDAQ 100 futures. We're now down only about 5% from Liberation Day. We're flat from Trump's Powell termination tweet. This all started out with comments from Treasury Secretary Scott Bessent behind closed doors at JP Morgan, followed on by Trump echoing that sentiment that they would be nice to China and that tariffs would fall. Meanwhile, stocks rally, the dollar rallies, that's starting to ease a little bit. Spreads tighten in corporate bonds and duration rallies. The 30-year yield was down some 9 basis points in the past 2 days. We add weight to that. We're down by nearly 9 basis points this morning. 4.78 is where you stand on your 30-year yield. Your 10-year yield lower by 5. Your 2-year yield little change this morning. By the way, gold taking a breather after posting 22 record highs. Let's take a look at some stocks that are also on the move this morning in the pre-market. With that is Bloomberg's Joe Easton. Good morning, Joe.
So Tesla, Danny, really the star of the show this morning. The stock jumping as Musk indicates that he's going to step back from some of his DOGE work, really taking the emphasis away from earnings that were pretty light. So Tesla gaining around 6% in the early pre-market trading. Bear in mind the stock coming into this report down around 40% year to date, so really just rebounding. Then Intel, the new CEO, wasting no time and announcing job cuts. Potentially 20% of the workforce could be cut, and that boosting the stock in terms of potentially some cost efficiency benefits for that one, so that one gaining as well. And then finally, Bristol Myers Squibb missing the primary endpoint on a schizophrenia drug, the words that no pharmaceutical investor wants to see in a statement, and that stock down almost 3% in the early trading. Keep an eye on Bristol Myers as we head towards the open in New York.
Joe, appreciate it. Great work as always. Bloomberg's Joe Easton. Now let's take a look on the dollar because it's been under pressure for much of 2025. On Monday, the DXY fell to its cheapest level since 2022, falling against basically all of its major peers in that trading session. Yesterday, on yet again that Trump pivot, you do get some strength coming from the dollar, this time that pivot happening on China tariffs and the fireability, if you will, of Fed Chair Powell. But I will say some of those gains seem to be fading this morning. Joining us now is Thierry Wizman, Director of Global Currencies and Interest Rate Strategy at Macquarie. Terry, great to see you this morning.
Good morning, Danny.
Look, risk assets clearly taking a lot of comfort in this. I wonder what you make of the fact that it doesn't seem to be an equal reaction across asset classes, and you even have the dollar this morning resuming some of its weakening.
Yeah, no, that's a very interesting point. We've got stocks rallying and the dollar's barely making a move here since the overnight session. I can't make that much of it. I think ultimately things do align with respect to what the prevailing narrative is. So if the prevailing narrative, of course, is that we're going to walk back, the U.S. is going to walk back from the very aggressive tariff situation that the president has imposed, I have a suspicion that the dollar will rally because remember, the weakness in the dollar that we've seen in the first quarter was really a result of the feeling or the perception that U.S. institutions were failing and didn't have any integrity anymore. And tariffs were a big part of that. So I think the dollar would rally if tariffs were to be walked back. I think the stock market would rally too. And I think that's the alignment that at least the stock market is looking for this morning.
So that narrative, the concern about integrity, about America's financial institutions, even if Trump let's say he completely capitulates on tariffs, does that narrative go away?
I don't think so. Tariffs is only one aspect of what is needed for the financial markets to be comfortable and feel secure in the knowledge that American institutions have integrity and are stable and are enduring. What's happening with the Fed and Fed independence is another institution. What's happening with the fiscal situation and the nature and contours of who runs the executive branch are another issue. Whether Congress can act as a effective check and balance on the White House is another institution in the United States. I think that tariffs is only one issue, and even if we resolve the tariff issue and get some clarity, I think that foreign investors, but also U.S. investors to some extent, have lost faith in U.S. institutions semi-permanently. This may endure at least until we get to the end of this Trump administration.
Does it go so far as to say, especially when you look at what's happening with duration, the fact that yields have been led higher by real rates, it's not necessarily inflation concerns, that there's an element that along this trajectory is one where you start to lose that exorbitant privilege that America has to spend, that people will keep funding our twin deficits. Does that come under threat too?
Oh, absolutely. One of the interesting things about the U.S. Treasury market and the U.S. Treasury is that effectively it serves as the prime broker for the rest of the world. People feel comfortable holding Treasury securities because they could be used as collateral. They're taken as good collateral just about everywhere. And if people have lost faith in the ability of the U.S. to honor its obligations, that aspect of the U.S. Treasury market, but also indirectly of the dollar itself will fade and be lost and start to crumble. So I am concerned, and I'm concerned specifically that you might see the rating agencies, Moody's, for example, downgrade or issue a warning on U.S. debt if we continue to see this continuous chipping away at the integrity of U.S. institutions.
Well, it's interesting because you're not describing a recession, you're not describing a shock. It's more this slow grind of change. And paradigm shifts take a really long time to happen. How do you even begin to imagine what that looks like 5 years' time, 10 years' time?
Well,
how do you think about that?
Yeah, well, if what I'm thinking and what I'm suggesting indoors, we're going to be living in a world where it's going to be much harder for the U.S. Treasury to finance its deficits. Now, there may be incredible amount of political pressure to reduce those deficits as a result, and that might be actually a good thing that comes out of this pressure, that we're finally resolved to do something about it. I also see the prospect that the dollar will be structurally weakened. Another way of saying this is that the era or the narrative of American exceptionalism that we enjoyed in the fourth quarter of last year and the beginning of the first quarter of this year is likely not going to recur. I do not see a situation, again, where there's that much enthusiasm around the U.S. growth and the U.S. dollar again in the next few years.
So if we don't have that enthusiasm, we have troubled relations, international relations. Again, let's play with the scenario that Trump does walk back to a large degree these tariffs. How do you think about where the 10-year yield should be?
Well, I think to the extent that there has been a an impulse or an effort on the part of investors to get out of the dollar and to get out of treasuries. It's a little bit overdone. You could see that with respect to, by just looking at the speculative positioning of traders in the CFTC reports. The speculative length is extended in the yen, in the euro, in foreign bonds, sovereign bonds like Buoyants, for example. So technically speaking, there's a little bit of overselling of the dollar, overselling of treasuries, and that could ratchet back. But that's really a short-term argument. It's an argument based on technicals. It's not really an argument about the structure of the U.S. economy and the U.S.'s financial sector 5 years out. 5 years out, if we do not see a change in the direction of U.S. institutions and the perception of those institutions, we're still looking at a world in which the dollar's weaker and U.S. Treasury yields are a bit higher than they otherwise would be.
Well, speaking of things that are a little bit more short term, we have some auctions to get through. We have a 5-year today, a week, 2-year auction yesterday. How do you juxtapose that with what has been strong demand in longer duration auctions we've gotten as of late?
Well, it's interesting. I think you have to balance two things here. One, of course, is that we presumably are seeing a lack of demand for dollar and dollar assets from investors abroad because all of a sudden they feel more secure in their own currencies and in their own bond market. At the same time, there is a lot of concern about recession in the U.S. and the prospect that these tariffs, by taking spending power away from the consumer, are going to cause a major slowdown in the U.S. This quarter and the next quarter. Now, it has been the case that in every recession since the end of World War II, with the exception of one, which was the recession in 1973, 1974, 10-year yields have fallen. So there is the pressure of buying the 10-year from the presumption that you want to get out of risk assets and go into something that's a little bit safer. At the same time, there's the pressure to get out of U.S. assets, generally including treasuries, from U.S. investors and foreign investors who feel less comfort with the U.S. and the U.S. dollar.
Terry, this has been so fascinating. Thank you so much for
pleasure.
coming and joining this morning. Really fantastic to have you on. That is Thierry Wizman of Macquarie. Okay, let's get you some other top stories now that are trending on the terminal. Speaking of rotating out of the U.S., Janice Henderson is weighing a 10% cut to its exposure to U.S. assets following trade turmoil. The firm's CEO told Bloomberg that he could see a tenth of clients' exposure reallocated from the U.S. to Europe, China, the Middle East, or Latin America. The admission underscores a growing shift away from the world's largest financial market. Cantor Fitzgerald, Tether, and SoftBank in talks to form a $3 billion crypto firm. Bloomberg sources reveal that the deal is expected to be announced in the coming days. Cantor formed a SPAC in January, raising $200 million to create a new firm. Tether will contribute $1.5 billion in Bitcoin, while SoftBank plans to put $900 million in. Vice President J.D. Vance says that it's time for Russia and Ukraine to say yes to the U.S.'s latest proposal for peace, or else America will walk away from the process. Speaking to reporters in India, Vance said territory concessions from both sides would be needed for a deal between Kyiv and Moscow, with new lines being drawn close to where the current front line is in the war. Coming up, shares of Tesla getting an extra boost this morning, rally in the pre-market. Elon Musk signals that he'll focus more on the firm. We're going to have more on that with Stephanie Brinley of S&P AutoIntelligence. That's coming up next.
Starting probably in next month, May, my time allocation to DOGE will drop significantly. I'll have to continue doing it for, I think, probably the remainder of the president's term, just to make sure that the waste and fraud that we stop does not come roaring back.
Musk comments there on taking a step back from DOGE, overshadowing Tesla's latest earnings miss. You saw their shares in the pre-market up more than 6% this morning. He said he would refocus his time to the car company, which is struggling under the weight of slumping sales and rising costs from President Trump's trade war. Joining us now is Stephanie Brinley, Associate Director of AutoIntelligence at S&P Global Mobility. Stephanie, thanks so much for joining this morning. Let's put those comments to the side for just a moment, which clearly are impacting equity prices. I want to ask you about the earnings themselves, because we saw a miss on multiple fronts. What was your takeaway from them?
Well, with lower sales and higher costs, then you've got a margin impact. And we could see it coming in the sense that the sales had been down earlier in the quarter. It's to be expected, but they did still manage to squeeze out a profit. You're looking at operating margin of 2.1%, though. That's not strong in automotive for sure. And automotive is still a tight area. They did manage to do a 14.6 adjusted EBIT margin, so that was a little bit stronger. I also think it was interesting that their sales and deliveries of what they call other models, which includes the Cybertruck, were also down. And we've been looking at Cybertruck sales slipping quarter over quarter, month over month. They've been coming back down. So it does not seem like Cybertruck has been the knockout hit that they'd hoped it would be.
I mean, not only is it down, Stephanie, I was looking at the numbers. Cybertruck deliveries down a whopping 24%. Are we going to look back on the Cybertruck as a boondoggle? Is there reviving the sales of this monster of a car?
That remains to be seen. It seems like it's a difficult step. Now they are coming up with a long range version at $63,000 after incentives, so that could make a difference. And one of the things that they did note is that the Model Y and the Model 3 are now using U.S. source batteries in the U.S., so they should be eligible for more incentives. And the full range would be eligible for incentives as long as we have them. Of course, we don't know for sure how long we're going to have those, but as long as we have those, the Cybertruck is going to be an interesting one to keep watching. The lower price point could help. They did also mention that it would be shipping to Saudi Arabia this quarter as well, which would be the first international market for Cybertruck.
I was looking through the comments also in the earnings. One of the things they said, absent from macro issues, we aren't seeing any reduction in demand. I'm not really sure what that means, macro issues, Stephanie. And also for other automakers, we've seen this pull forward of people wanting to get out and purchase things. Is there a concern of brand reputation in Tesla? Could that be some of quote unquote macro issues that they're just kind of lumping in everything and maybe using that as a scapegoat as to why sales look weaker?
It could be. I think that it's still trying to figure out exactly how much was what they refer to as bad brand image. Or how much has to do with an older vehicle lineup. I mean, of course, over in the first quarter, they freshened the Model Y just a little bit, but the freshening of the Model 3 a year earlier hasn't seemed to move the needle, and maybe it won't. The products themselves are getting a little bit older, with the exception of the Cybertruck, and the competition is getting more fierce. And macroeconomics are playing a role in there. We do see sales coming down, and with the tariffs coming into effect, the rest of 2025 could look pretty bad all the way around. In the U.S., S&P Global Mobility's light vehicle sales forecast took our expectations for the U.S. market down to about 643,000 units. For the rest of 2025 based on the tariff impact. And that'll affect Tesla as well. That's going to affect everyone.
So we have Elon Musk saying that he's going to start refocusing on Tesla away from DOGE. Stephanie, how much confidence does that give you?
I'm not sure, actually. I mean, because I don't know that that's fundamentally the problem. If you've got an aging product lineup and some other issues coming into play, it may be more about product than it is about Musk, which is interesting to say, and the fact that he's overshadowed so much. But his attention being focused more on Tesla seems to, by the reaction of Wall Street, seems to affect Wall Street more so than it does the day-to-day operations of the company. Simply being in the office more days per week doesn't necessarily mean you've got a new buyer.
Stephanie, that's so fascinating. So just in the final minute here, what is the formula for success to overcome some of the issues that they're seeing?
You know, part of it will be if they do introduce the new, more affordable vehicle, what the reception is to that is going to be key. They have a small range, a small lineup, and they have a lot of competition. So some of it is going to really be, can they turn around the profitability in the future quarters? That, in some ways, is more important than the volume. We know volume is going to be challenged. Globally, we know volume is going to be challenged for most automakers over the rest of this year and all of next. In that environment, it might not be sales in and of themselves. It may have to do with profitability and cost. And adding an affordable model can make a difference still. With only a couple of cars, product is still king. and product is still where people are coming from, and competition is fierce. They need more product.
Yeah, Stephanie, again, it's such a fascinating view, given we've heard from other analysts saying that the formula for success is Elon Musk coming back. So a very timely commentary from you. Stephanie, thank you so much for joining us. Stephanie Brinley of S&P Global Mobility. Some breaking news to bring you. Apple, Meta, they have been fined by a total of about 700 million euros, or just under $800 million, by the EU for breaching tech rules. Those fines, I have to say, they're coming in even though we heard the U.S. President Trump warn of retaliation should the EU impose these fines. The breakdown, 500 million euros for Apple, 200 million euros for Meta. But those are a much lower figure than we had seen for prior penalties. Perhaps we can speculate that this is an attempt to still fine them, but avoid some of the most extreme of Trump's ire. So again, Apple and Meta getting a fine from the EU. Let's now move on to other earnings. We're going to get Boeing reporting before the market open. Analysts are expecting to see an improvement after a string of heavy losses. Now, the focus in particular will be on what the plane maker says about navigating turbulence. For more, we are joined by Bloomberg's Benedict Campbell, who leads our global aviation coverage. Benny, what are we expecting for the earnings today?
So overall, the picture is looking a little better for Boeing on an operational side. They have, under the new CEO, Kelly Ortberg, they've improved sort of the factory processes. So planes that are coming out in better condition, less repair work that's needed. They're coming out at a faster clip. The recent monthly deliveries have actually ticked up a bit. So all of those things actually look quite good. But then you have the tariffs and the macro environment that is sort of going the other way. So that's going to be one big thing that investors and analysts will be looking at, sort of how does Boeing navigate that? Will the progress that the company's been making, will that be undercut, maybe even sabotaged by the macroeconomic developments? We've heard that China, in particular, has stopped taking Boeing aircraft, and that's obviously a huge market. It's the second biggest aviation market after the US. So that's something that people will be looking out for. How will Boeing navigate that? Can they find other markets? India comes to mind. The good news for them is that they have a lot of demand for their products. So being able to mitigate what's going on in China and the broader economic fallout, that's going to be a big theme of the earnings that hit in a couple of hours.
Hey, Benny, I got to ask then, what did you make of GE Aerospace yesterday? Basically giving an unchange to their outlook, saying demand is still there, a crucial component for many of these plane makers when it comes to engines. Does that maybe set expectations a little bit higher for someone like Boeing today?
Yeah, the demand picture is still quite strong, but this is the here and now, and we'll have to see how this plays out in the next couple of months. We have heard anecdotally from a number of airlines that say that, in particular on the transatlantic route, things are looking a little bit softer. We heard from Virgin Atlantic, for instance, just today, Richard Branson, the founder, saying that things aren't looking that great. So once that seeps into the wider market and into the manufacturing side, that positive picture might change fairly quickly.
Benny, thank you so much. Bloomberg's Benedict Campbell there on Boeing earnings. This is Bloomberg. Let's get you set up for your trading day on this Wednesday. Boeing will be reporting earnings before the bell, IBM after the market closed. Then a lot of Fed speak, Goolsbee, Musalem, Waller, Hammack, and Kugler all throughout the day. Plus U.S. PMI data that comes out at 9:45 a.m. Eastern. A quick look at some stocks on the move. Intel, those shares are rallying in the pre-market. Bloomberg sources saying they're going to cut 20% of staff. Tesla earnings there. Elon Musk says that he's going to refocus on the company, put aside the poor showing from the earnings themselves. That stock is rallying. Finally, Emphas Energy, one of the few stocks in the red this morning, down more than 10% after a Morgan Stanley downgrade. All right, that is it for your Bloomberg Brief this morning. Surveillance will take things from here. This is Bloomberg.